Hey everyone, Hunter Satterfield here, one of the partners of Kane Waters and Associates, as well as the Chief Investment Officer. As always, I am joined by my fellow partner, Brian Bortz, who heads up the CWA Investment Committee, and then also Brad Sanders, the Managing Director of Tectonic Advisors. We join you today for your October market update. The month of October was a wild one, another wild one for the year. The S&P 500 was up 8.1% for the month. Global stocks up 6.2% for the month. Domestic bonds down 1.3% for the month. And then global bonds down slightly at 0.7% for the month. And I have to say for the month because that 8.1% return is not actually an annual return. That is just what happened in October. Now, if you go back and watch our recording from last month, you'll see, or you may remember if you have, that we already discussed that we anticipated this to happen as far as the markets going up for the month. And so, Brad, let's start with you. Can you kind of tell our viewers a little bit about what did happen to kind of cause the equity markets to bounce a little bit?
Yeah, I think the causality there is just the anticipation that the Fed is about to start slowing the rate of their rate hikes. So slowing the pace of them, not doing 75 basis points anymore, and that's really all it took. Our comments in September were around some of the historical data around the month of October was pretty good, but really the main thrust of it was that we were oversold in the short term by pretty much any technical metric you want to look at. And when you see markets get that oversold, which just means they've gone down too far too fast, right? Doesn't mean that they're not fairly valued. It just means you don't typically lose 8% in a month like that. Whenever you get old, so you're pretty vulnerable for a snapback rally, a lot of short covering, things like that. I would just caution everybody, this is not a bull market. That's very clear. We're starting to focus, there's been a lot of hand wringing and pearl clutching about the Fed and the CPI all year. I think the writing's on the wall that the Fed's going to win out. And when you start digging through the components of the CPI, you see the PMI numbers that came out yesterday that were below 50. They were bad. Some of the housing data coming out is not good. Credit card debt has gone up a lot in aggregate. And we all need to remember that 72% of GDP in the United States is based on consumer spending. So, whichever way you want to slice it, it looks to us like a mild recession is on the horizon. And so we're spending a lot of time focusing in on earnings and actual economic data because I think, that's going to be the true driver of markets over the next 6 to 8 months as we kind of enter in this recession. Interestingly, the market's already dropped 25%, a little over that at its worst point. The market generally goes down about 30% in a recession. So we could be getting into a scenario where, yeah, we're in a confirmed recession, but there's parts of the market that are already rebounding because they've already been washed out. And that's where we've been putting money. We put a new manager in place yesterday for that very reason. We're looking at areas of the market where we can stay invested, but do so being mindful of valuations and being mindful of earnings and making sure we have kind of a wide moat around our portfolio.
Yeah, that's great. And Brian, I want to come over to you because I think, Brad is absolutely right that we've still got continued volatility and some choppy waters for sure coming. And as we look back to the monthly returns during 2022, we see a lot of these big swings like we saw in October and September on the downside. And so you want to talk a little bit about what that means, what we see on our side of things and what that means for client portfolios as we see these big swings back and forth in client portfolios and the markets.
Yeah, thanks, Hunter. It's exactly what you just said. In 4 out of the last 5 months, we have had market moves either to the positive or to the negative that would equal what we'd expect to happen in almost a year. June was down over 8. July was up over 9. September was down over 9. October was up over 8. So, I mean, you have these massive moves that are happening on a month-by-month basis. And, the only person that gets to be less accurate than a weatherman is an economist. An economist gets to say, oh, I think we're going to be in a recession. No doubt. Every technical measure that we look at really points to we're either about to enter a recession or already have been in one. And like Brad just mentioned, I think there's an incredible opportunity for people who are paying attention to actually look for entry points in certain sectors and certain points of the market as we move forward to take advantage of this market. And there may be, as we've talked before on the investment committee, it may actually be a generational opportunity, meaning something that happens every 20 to 25 years. This has been an interesting market that has already seen a lot of downturn, and clients are getting anxious, but we're approaching the end of this rate hike period. We're not done with it, but the Fed's going to come out tomorrow, and it's probably going to be 75 basis points. The most important thing that I want our clients to hear from that is going to be, what does the Fed point to after that? Are they going to point to slowing down? Are they going to point to, yeah, we're going to keep going pedal to the metal? And if it starts to slow down, the market's going to react very favorably to that in the short term. But as Brad said, that's not a bull market. That's just the market going, okay, now we know what direction. So lots of positive potential out there, but we're being cautiously optimistic given all this volatility.
Yeah, it's good. And you mentioned the Fed rate hike that is likely coming tomorrow. And Brad, I want to come back to you very quickly on just one more thing, because a lot of what we're seeing obviously is that, so as we have these volatility spikes both ways on equities, bonds haven't necessarily recovered as much. I mean, at what point are we going to see some sort of retracement back to the positive, within the fixed income markets?
I think that's Fed dependent. I think really what you've got going on in the bond market is just a buyer's strike. There's just no buyers. And so if you look at the underlying fundamentals of the fixed income market, it's not bad at all. I mean, if you look at credit spreads, they've widened a little bit this year, but they're really not marching higher, which, normally going into a recession, you would see bloating credit spreads and a lot of potential there. What's interesting is the credit markets, normally going into a recession, you kind of look at what comprises those credit markets, and usually those are the pain points. And most of the issuance, like over 20% of it in the high yield space over the last 5-6 years, has been energy. Well, guess what? Energy is making money hand over fist right now. So if you look at the overall fundamental health of the bond market in terms of its ability to recover, that's all intact. And so I think what we're just going to need is the Fed to do this hike tomorrow. It's going to be 75 basis points. Let the market digest that. I think what you'll hear from the Fed is them starting to maybe hint towards, next one's going to be 50, then maybe the one after that's 25, and then we're going to take a wait and see. And I think once you kind of give the bond market participants that sort of direction, you'll see the buyers come back in. And then once that happens, that liquidity discount will snap back, and that's going to make things look a lot better. We're going into the end of the year. You're going to have tax loss selling in that space. You're going to have a lot of stuff that we're not normally used to seeing in the bond market. So it may be a 2023 story at this point. It wouldn't surprise me if the bond market rips a little bit towards the end of the year if the Fed says the right thing tomorrow. But I think it's a first quarter 23 story, and I think we'll see our bond portfolios get pretty healthy from that point.
Yeah, that's awesome. Well, I think as we head into November and the holiday season, the big thing I think for all investors is as Brad and Brian have said, is we still have some choppiness on the way. And so remaining sort of long-term focused and staying invested throughout this is one of the most important things for individual investors to be able to do. So we'll be back in front of you after the Thanksgiving holidays. Hope you have a wonderful holiday break, and we will see you at the end of November. Thank you so much.